10 real estate test questions. These are going to be related to financing that are going to help you pass your real estate exam. My name's Darren Sy. I'm a licensed real estate agent and loan officer here in California. I'm making this video so you can pass your real estate exam on your first try. Let's dive straight into the financing questions. Question number 1. Which loan is often used by older homeowners who have owned their homes long enough to gain a great deal of equity? A. Variable or adjustable rate mortgage. B. Shared appreciation mortgage. C. Rollover mortgage. D. Reverse annuity mortgage. The correct answer here is going to be D. Reverse annuity mortgage. So a reverse annuity mortgage is when the lender actually pays the borrower. The loan is not repaid until the borrower dies or sells the home. A more common name for this loan product is just called a reverse mortgage. I'm sure many of you have already heard of these. To make sure you get this question right, it's really important that you know what each type of those loans is. Question number 2. The taking of another person's rights and obligation in a pre-existing contract is known as A. Novation. B. Ostensible liability. C. Assignment. D. Assumption. Correct answer here, it's D. Assumption. So once again, to get this question right, you're going to need to know the definitions of each of these words. That will make it super easy for you to get this answer correct. And let's walk through the explanation here. Assumption simply involves taking or receiving another person's rights. Assignment refers to giving the rights under a contract to someone else. And novation actually releases the withdrawing party from liability under a contract. If you know the definition of all 4 of these terms, this is an easy question for you. Question number 3. Who are the parties to a mortgage? A. Mortgager, mortgagee. B. Lender, lendee. C. Trustor, trustee. D. Vendor, vendee. We're not talking about a vendee Starbucks here, okay? The correct answer here is A. Mortgager and mortgagee. So the parties to a mortgage are the mortgager, who's the borrower, and the mortgagee, the lender. Question number 4. When a trust deed debtor is in default on a loan, the loan may be reinstated if all delinquencies and fees are paid prior to how many days before a trustee sale? A. 5 days. B. 3 days. C. 7 days. D. 10 days. Correct answer here is A. 5 days. So basically, a borrower has until 5 days before a trustee sale to pay all the delinquent amounts and fees. Question number 5. What type of note calls for interest payments during the term of the loan and principal due at the end of the loan? A. Balloon wraparound loan. B. Amortized loan. C. Installment loan. D. Straight term loan. The correct answer here is D. It's a straight term loan. In a straight term loan, only interest is paid each month, and a lump sum principal payment is due at the very end. Most 30-year fixed mortgages that we are familiar with are amortized loans. So that means every month, the borrower is paying both principal and interest. Okay, so now that we've gone through 5 financing questions that are going to help you pass the exam, if you want a test bank of your own questions and to really prepare for the exam, I'm going to drop a link in my description. So full disclosure, it is an affiliate link. I do get paid a little bit if a purchase happens. However, Calibri is the platform that I use to pass my real estate exam and loan officer license exam on the first try. I'm currently using their platform to get my broker's license as well. So it's a platform that I actually used, and I stand by their product. Back to the questions. Question number 6. A GI loan is the same as A. A co-insured loan. B. A conventional loan. C, a FHA loan. D, a VA loan. The correct answer here is D, a VA loan. So a GI loan is often referred to as a soldier's loan, and it's guaranteed by the VA, which is the Veterans Administration. So GI loan, VA loan, essentially the same thing. Question number 7. The term debt refers to A, an instrument used in many states in place of a mortgage. B, the amount of money owing on a note or a promise to pay. C, the transfer of real property by a private owner to a public agency. D, the movement of money out of savings into a higher yield investment. And the correct answer here is B, debt refers to the amount of money owing on a note or a promise to pay. So with this question, once again, if you know the definitions of certain words, you're going to be able to answer this question pretty easily. Question number 8. The type of lender having the greatest percentage of assets invested in residential mortgages are A, mutual savings banks. B, savings and loan associations. C, life insurance companies. D, commercial banks. The answer here is B, savings and loan associations. So, savings and loan associations are the most invested in residential mortgages. They take deposits in savings accounts and they use those funds to make loans for depositors. If you think about your local credit union, right, that's like a savings association. Okay, question number 9. Mr. and Mrs. Buyer are approved for a $72,000 loan. Their monthly payments will be $9.35 per thousand for 30 years. How much interest will they pay over the life of the loan? A, $170,352. B, $601,200. Answer C, $242,352. Answer D, $673,200. Correct answer is A, $170,352. I'll just walk you through the math here, right? So your loan amount is $72,000. You divide that by $1,000, right? And you get 72. You take the 72 times the $9.35 per thousand for 30 years. You take that 72, multiply that by the $9.35, which gives you a $673.20 monthly payment. You take that monthly payment number and you multiply it by 360 months, which gives you the total payment of $242,352. And then you subtract the loan amount, and that will tell you the interest. That is a lot of interest. It is more than the actual loan balance. So if you notice, Mr. and Mrs. Buyer are actually paying more interest than the actual loan itself over that 30 years. And this is why and how banks and lenders make so much money over a long period of time. Question number 10. We're here at the end. Under the Uniform Commercial Code, also known as the UCC, all of the following are required to be on the face of a promissory note except, notice that except in there, A, paid to bearer or to order. B, payable on demand or at a definite time. C, the holder's signature. D, made by one person to another, both able to legally contract. Correct answer here is C, the holder's signature. So the UCC requires a note to be signed by the maker of the note, the borrower, but not the holder of the debt. Those are 10 financing related questions you will likely see on your real estate exam. I hope you passed your exam on the first try. I'm going to drop a link to a weekly newsletter I send to brand new agents or just agents in general, sharing my experiences and mistakes that I've made and things that are going to help them grow their business. So if you're interested in that, there's a link down here. Thanks again. Good luck on your exam.